The rate hikes are expected to begin in May, and they're planning on doing 3 total rate hikes in 2022. Living life, doing our best, and helping families succeed in homeownership. In our last episode, we talked about what happened with interest rates, home values, and loan amounts in the year 2021. And today we're going to take a look at a forecast. What is expected for our housing industry moving forward into 2022? The Federal Reserve will play a major role in 2022. One of the things we expect them to do is to continue to taper. Now, tapering is a reduction of the bond buying program of the US Federal Reserve. One of the reasons the Federal Reserve has been tapering is to try and suppress inflation. The Federal Reserve is expected to be done tapering by March 2022. Now, as they complete this will likely lead to rate hikes in the Fed funds rate. The rate hikes are expected to begin in May, and they're planning on doing 3 total rate hikes in 2022, and possibly another 2 to 3 rate hikes in 2023. If the Fed can tame inflation, we can expect mortgage rates to drop. However, they may drop from higher levels, meaning if the average rate is 3.5%, and then rates go up to 4%, you might see them come back down to 3.5%. As I've said, predicting the future is rather difficult. However, we do have data. So let's take a look at our economic history to see if we could recognize some patterns to give us clues on what we could see happening in 2022. So let's take a look at this chart and look for patterns. During the 1970s, Burns and Volcker were the Fed chairman. In the 90s, it was Alan Greenspan, and then today, Mr. Jerome Powell. Now, inflation during their reigns, look at what happened. During the Burns and Volcker reign, inflation went from 7% to 14%, Alan Greenspan, 2 to 3.5%, Jerome Powell, 2 to 7%. Now, let's take a look at the interest rate activity that came from this inflation. Mortgage rates went from 12% to 18%. Can you imagine paying 18% for your home mortgage? Well, yes, my friends, it happened in the 1970s. Alan Greenspan era, interest rates went from 7% to 8.5%, and then Mr. Jerome Powell from 2.5% to 3.375%. Now let's take a look at what the Fed did with the Fed funds rate. Burns and Volcker decided to take the Fed funds rate from 11% to 20%, Greenspan from 4.75 to 6.5%, and we're expecting Jerome Powell to take it from 0 to 1% in 2022. Now take a look at how inflation reacts to the Fed funds rate activity. Inflation in the Burns era went from 14% to 5%, so they tamed it, it went down. Alan Greenspan, it repeated again, it went from 8.5% to 1%. So if we see this in 2022 and the Fed funds rate increases, that's an attempt to control inflation, and we should see inflation drop. Now let's take a look at one more thing. What happened after inflation? What happened after the inflation response? Look at rates. Burns and Volcker era, the interest rates went from 18% to 12%. Greenspan era went from 8.5% to 5.5%. Now, should this same cycle repeat, we should see a decline in interest rates. From the MBS highway chart that we just reviewed, this is why it's expected and forecasted for interest rates to rise during the first half of the year, possibly as high as 3.75%. And then in the second half of the year, as the Fed fund hikes their rates, we can expect them to start dropping closer to 3%. When it comes to housing and housing demand, it's expected to continue to be strong moving into 2022, but definitely not as strong as it was in 2021. Now, supply, we will definitely have a little bit more supply as far as housing inventory, but it will remain tight. Another key point that is expected to happen is rates will increase. It's estimated that we may see a 5% increase to rental rates. Now, this rental increase will definitely cause many to reconsider home buying, as now a rental payment versus a mortgage payment starts looking a lot more attractive. There you have it. That's what's expected for 2022. I wish you and your family a prosperous, loving, and happy 2022. And as always, if you have any questions, give us a call, shoot us a text. We're at your service.